India has never failed to highlight the frenzy of the stock market. A market that has been slowly maturing for decades now. Slowly,
Indian stock markets rally up.
incrementally,
The Nifty and the Sensex are in record high.
growing.
Sensex reaches 64,000.
From the infamous meeting under a banyan tree to handwritten ledgers and now high-frequency algorithms, through economic liberalization, through tech booms and busts, through global financial storms, a market adapts and evolves. The stock market isn't just about numbers, data, or charts. It's also about people, their ambitions, their fears, and their dreams of prosperity. And as people change, so does the market, which is why you can't predict a market. And now that a new generation of investors has arrived, armed with smartphones, endless information, and a huge appetite to invest, the last few years have reshaped the market in ways no one could have imagined. So it's time we look closely at what's been happening. This is the story of the Indian stock market. Our story starts with our national tree, the banyan. Sacred across multiple religions and cultures, it was under a banyan tree that the Indian stock market found its origin. It was here, gathered underneath this tree in front of Mumbai's town hall, where plans were made to start the Native Shares and Stockbroker Association. This is the organization that would eventually become the Bombay Stock Exchange. At this time though, trading looked nothing like it does today. Traders would gather underneath the banyan tree to conduct business. Deals were made verbally and sealed with simple handshakes. Share certificates looked like this, and trades were recorded manually in ledgers. Information spread through word of mouth or written notices, and settlement periods were much longer than today. Trading was limited to just a small group of brokers who knew each other. You have to remember, this was Asia's first stock exchange. At the same time, a parallel financial system was thriving, one deeply rooted in trust and necessity, the hundi system. Imagine a merchant in Gujarat needing to send money to Calcutta. Instead of risking robbery on dangerous roads, he'd visit his local hundi trader. He would receive a note on palm leaf paper, a sacred promise, and now suddenly his money could travel thousands of kilometers without moving an inch. These pieces of paper, backed by nothing but honor and reputation, powered India's commerce for centuries. So as you can imagine, there isn't a lot of data for this period, but we did find this journal outlining India's foreign trade in the 19th and early 20th century. Here you can clearly see the upturn once the market started the process of formally organizing itself. 1870s Bombay was a time of transformation. Cotton money was flowing through the streets, creating India's first generation of industrial tycoons. But investing? That was a game played by very few. The presidency banks of Bombay, Bengal, and Madras controlled most of the formal lending. These were the predecessors to today's State Bank of India. For the average Indian merchant, the path to raising capital meant either approaching these colonial institutions or relying on traditional moneylenders. As a result, the early investment landscape was dominated by very few key players. European managing agencies who were controlling most large companies, native industrial houses emerging in textiles and shipping, traditional banking families who were beginning to experiment with modern financial instruments, a small but growing class of wealthy Indian investors, mostly from merchant communities, and the shares being traded, primarily cotton mills, banks, and the East India Company itself, which was one of the first joint stock companies in the world. This was a market that reflected colonial power, but also a growing Indian entrepreneurial ambition. There was something brewing in Mumbai's business district. The city's native merchants were growing in wealth and influence. They weren't happy with just trading cotton or opium. They wanted to build industries, start banks, and create wealth on their own terms. These guys challenged the colonial financial order. Post-independence, however, India's stock market entered a period of restricted growth under Nehru's socialist vision. The Bombay Stock Exchange, once a symbol of free enterprise, found itself operating in an economy increasingly dominated by state control. We saw a web of regulation tighten around the market during this time. The Capital Issues Control Act of 1947 gave the government complete control over new share issues. The Monopolies and Restrictive Trade Practices Act of 1969 further constrained private enterprise. The Foreign Exchange Regulation Act of 1973 restricted foreign investment. But the story of this era isn't just about policy and very slow upward trends. It's about culture too. Stock market participation remained confined to a select urban elite. For the average Indian, investing meant one thing: fixed deposits. At the time, the market was viewed with suspicion, seen as a satta bazaar, a gambling den for the wealthy. Trading itself remained almost ceremonial in nature. Brokers still gathered on the trading floor using their unique hand signals and gestures. Physical share certificates were still the norm, often leading to long delays and endless paperwork. The entire system operated on personal relationships and trust, for better or for worse. But beneath this largely stagnant surface, pressure was building. The market was waiting to transform, a moment that would arrive with the reforms of the 1980s and eventually exploded in 1991. India was at the brink of bankruptcy. Gold reserves airlifted to London and the economy was gasping for breath. This is when the economy was liberalized and the license Raj was dismantled piece by piece. As a result, the market responded with unprecedented enthusiasm. The BSE Sensex, which had taken 12 years to reach 1,000 points, would now witness rallies that were previously unimaginable, and this changed the way India traded. The establishment of the National Stock Exchange in 1992 brought screen-based trading to India. The old guard of BSE faced its first real competitor, one that would help democratize India's market access. And by now, we had SEBI, the new market watchdog, wielding powers that would have been unthinkable in the earlier era. Physical share certificates? These became remnants of a bygone era with the introduction of demat accounts. Foreign investors who were previously locked out now began pouring in. The daily trading volume exploded. New financial instruments emerged. But most significantly, the stock market was no longer just a rich man's playground. It was becoming a part of middle-class aspirations. This wasn't just a policy change. This was the Indian market finally breaking free and spreading its wings into the modern era. And this is also the time we finally got access to proper data. So let's take a look at the BSE Sensex. Its base year is 1978 to 79. Now immediately, you'll notice responses to significant market events. But you can also clearly see the market normalize into typical cycles. Let me quickly explain what a typical market cycle looks like. It starts with an accumulation phase. This is where smart money starts buying when the market seems to have bottomed out. This leads to a markup phase where the prevailing trend becomes clear. This is where public participation increases and the distribution phase begins. Smart money starts selling to the late entrants. This results in a markdown phase where prices start to decline again and general sentiments start to turn negative. The launch of derivatives in 2000 changed trading dynamics, attracting institutional investors and speculative traders alike. The shift to dematerialized securities eliminated inefficiencies and increased retail participation. It was clear by now that the stock market had matured significantly. The growing role of FIIs brought liquidity but also introduced vulnerability to global market volatility, which is why the global liquidity glut, particularly post-2003, drove massive inflows into India's emerging market. Valuations in sectors such as IT, real estate, and infrastructure soared, fueled by the global commodities boom and the BRICS narrative. But the 2008 global financial crisis exposed overvaluation in several sectors. The market did mature, and this did make it stable, but there is an inflection point here that nobody expected.
The mysterious new virus.
Coronavirus.
There are fears a rapidly spreading virus.
The Sensex has now also gone down.
As COVID-19 gripped the world, the Indian market witnessed its fastest crash ever. The Sensex plummeted, circuit breakers triggered, trading halls emptied. In those early days of lockdown, it seemed like the market was heading for its darkest hour. But none of that happened. Instead, the market went the complete opposite direction. Average daily turnover doubled from Rs 48,000 crores in March 2020 to over 104,000 crores by December 2024. The number of monthly equity trades on NSE surged from 26 crores to 74 crores. The cash market turnover exploded, hitting its peak in 2024. Numbers that had stayed flat for nearly 2 decades suddenly went vertical. Looking at this through retail participation might give you a better picture. Pre-COVID, it took 8 years for unique investors to double to 1.5 crores. Post-COVID, just 2 years for the next doubling. In 2024, we were looking at 11 crore unique investors. North India, which was previously a minor player, now accounts for 30% of all registered investors. The proof for this retail revolution is best highlighted in the flows. Individuals had been cutting down their trading activity before the pandemic hit, leading to 8 years of negative retail investment. Post-COVID, investors poured in rupees 4.4 lakh crores directly into equities. That's not counting mutual funds, where unique investors jumped from 2 crores to over 5 crores. The markets finally expanded. You see, for the longest time, everyone from SEBI to traders to fund managers to all sorts of other large allocators complained about the lack of liquidity in the Indian market. And they were right. Even as recently as 2018 to 19, liquidity quickly vanished when you looked beyond the top 100 companies. But after 2020, this changed for all the better. All market segments aren't fully liquid yet, but compared to the pre-COVID baseline, things have improved substantially. Those old liquidity problems are finally changing. There are almost 5,000 stocks listed on the NSE, and not all of them trade regularly, which meant the trend was more or less flat between 2012 to 2020. But post-COVID, it spiked from 2,400 to 3,800. This could mean more stocks have liquidity now, but more likely it means that all sorts of small and micro scammy stocks suddenly started seeing activity. But regardless of whether it's smart money or speculative mania, the market has never been more alive. Taking a closer look at mutual funds, the numbers tell a story that's almost hard to believe. From March 2020 to November 2024, the industry's assets under management nearly tripled to rupees 68 lakh crores. SIP investments surged from rupees 2 lakh crores to rupees 13 lakh crores, with monthly inflows tripling to rupees 25,300 crores. Years of financial literacy campaigns couldn't achieve what a global pandemic somehow did, turning Indians into equity investors. And yes, there's speculation. Yes, there's a frenzy. But there's also something more profound. Mutual funds have become a household name. And unlike hot money, these investments tend to stick around, making our markets more resilient than ever before. This is the dawn of India's equity culture. Post-COVID, we witnessed a seismic shift. Indians are finally moving beyond their love affair with bank deposits. Their money is finding new homes in stocks, mutual funds, gold, and real estate. When you look purely at financial savings, this point becomes crystal clear. A good chunk of this money has flown into financial assets like stocks and mutual funds, but a lot more of it has gone into physical assets like gold and real estate. Hey, you take all the wins you get, right? When you only look at financial savings, you can see a noticeable shift away from bank deposits to equities and equity mutual funds. The point is, the great Indian investment mindset is changing, even if the data can't fully capture this transformation yet. The unprecedented rise of IPOs also helps bring home this point. From a declining trend of 40 to 50 listings annually, the market exploded to over 100 IPOs a month. Companies that once raised rupees 20,000 crores yearly are now pulling in multiples of that amount. The promise of listing gains turned IPOs into a retail investor magnet. Even with the limited retail allocation of 35% for strong companies and 10% for riskier ones, the rush to participate has been a clear sign of India's newfound appetite for market risk. This newfound appetite, by the way, is no accident. This is just another consequence of a market that is getting younger. In 2020, only 23% of Indian investors were under 30. By 2024, that number has nearly doubled to 40%. This isn't just a statistic. It's a glimpse into India's financial future. What we're witnessing isn't just growth. It's a Cambrian explosion in market evolution. Digital infrastructure and financial inclusion laid the groundwork, but COVID became the catalyst that changed everything. Under the surface of a decade-long bull run, millions rushed in. Of course, they're young and sometimes reckless, but they're always eager to experiment, from IPO flipping to penny stocks to options trading. Yes, there's speculation. Yes, there's inexperience. But for every poor decision in this bull market, there's someone else learning to be smart with their money. Bank deposits are giving way to equity investments. SIPs are becoming household terms. The market isn't just getting bigger, it's getting deeper. What we're living through is called an interregnum, the chaotic period between two states of normalcy. This exponential growth won't last forever. A new equilibrium will emerge. When? How? Nobody really knows. But one thing is certain, India's market will never be the same again.